Welcome to The Explainer. I'm absolutely pumped to take you through this one today. We're using the 25th anniversary of the infamous dot-com bubble to dig into something totally fascinating, the timeless human psychology that literally drives financial manias. Because honestly, to grasp what's happening in our markets today, we've got to understand the intricate wiring of our own minds first. All right, let's look at our roadmap. We're going to hit the anatomy of a bubble, the psychology of speculation, the boom and bust, survivors of the crash, and finally, lessons for today. We're connecting 90s history straight to brain chemistry and today's AI market. Let's get right into it. Section 1. Anatomy of a bubble. Peak euphoria. Okay, I want to transport you back to the late 1990s, the absolute climax of a financial mania that really changed the world forever. Look at this number. 86%. According to historical data from Goldman Sachs, the tech-heavy NASDAQ index surged an unbelievable 86% in 1999 alone. Think about that for a second. This massive, unprecedented spike in stock prices was totally unwarranted by the modest growth we were seeing in actual corporate profits at the time. The market had basically disconnected from fundamental economic reality. This disconnect was actually so alarming that way back on December 5, 1996, Fed Chairman Alan Greenspan delivered a really ominous warning. He coined the famous phrase, irrational exuberance. And what he meant by that was just wishful thinking was beginning to completely blind investors to the fundamental reality of the market. People were valuing companies based on what they dreamed they could become, rather than the hard facts of what they actually were right then. So, to understand how this happens, we really have to contrast two very different views of the market. On one side, we have traditional finance's efficient market hypothesis. This assumes completely rational decision-making. It assumes investors look at objective data, calculate intrinsic value, and just act logically. But the reality? Well, that's behavioral finance. This acknowledges irrational decision-making, where choices are driven by raw emotions, wild speculation, and just intense social pressure. And this irrationality actually follows a surprisingly predictable curve over time. It always starts with a displacement, like a new technology, say the internet, which kicks off a boom. Then, fueled by that irrational exuberance we just talked about, it skyrockets into the euphoria phase, where prices just totally defy all logic. And finally, inevitably, it plummets into collapse as panic selling takes over. It's a perfect visualization of human emotion completely overriding logic. Moving on to Section 2, Psychology of Speculation, the Mind of the Crowd. To figure out why this boom and bust cycle happens, we have to look inside the human brain. It starts with a nasty cognitive bias called overconfidence. This is when investors vastly exaggerate their own forecasting prowess and their ability to control market results. During the dot-com boom, retail and institutional investors alike genuinely believed they had cracked the code. They thought they could predict this entirely new internet economy without fail, which of course led them to take on excessive, downright catastrophic levels of risk. Now, what's really fascinating here is how social proof completely overrides logic. We call this herding. It's when investors blindly follow the actions of the crowd, succumbing to massive FOMO, the fear of missing out, instead of doing their own independent analysis. In the late 90s, people were buying stock in literally any company with a .com at the end of its name. Why? Simply because their neighbor or some guy on TV was doing it. And then we run right into loss aversion. This is a deeply ingrained psychological bias where the pain of losing money is felt twice as intensely as the joy of gaining it. Now, you'd think this would make people sell early to avoid losing their shirts, right? But ironically, it does the exact opposite. Loss aversion trapped investors. They completely refused to sell depreciating assets, riding these doomed tech companies all the way down to the bottom, desperately hoping the stock would bounce back so they wouldn't have to formally realize the loss. And if you're sitting there thinking this is just some modern phenomenon, think again. Even Sir Isaac Newton, arguably one of the most brilliant minds in human history, lost an absolute fortune in the 1720 South Sea bubble. He famously said, "I could calculate the motion of heavenly bodies, but not the madness of people." It really goes to show human nature remains remarkably constant. The technology changes, sure, but the brain chemistry driving these massive booms and busts, that is exactly the same. All right, Section 3, the boom and bust, visualizing the carnage. To truly grasp the breathtaking speed of this collapse, let's walk through the timeline. Throughout the late 1990s, we saw this massive wave of internet IPOs. This all culminated on March 10, 2000, when the Nasdaq hit a dizzying peak of 5,048. But as we know, the euphoria didn't last. By November of that very same year, the index plummeted below 3,000, and the bleeding didn't stop there. On October 4, 2002, the Nasdaq bottomed out at 1,139.90. That is a devastating 77% fall from its peak, just a complete wipeout. When we zoom out and impartially map the 2000 crash alongside other broader historical patterns, whether we're talking about 1929, 1987, or 2008, the underlying mechanism is largely the same. Systemic overspeculation leads to an entirely unsustainable bubble, which ultimately bursts, evaporating absolutely massive amounts of wealth. In the dot-com crash, that was one of the most severe wealth evaporations in modern financial history. Which brings us to Section 4, Survivors of the Crash, the Graveyard and the Gladiators. Let's shift our focus to some tangible stories, the actual companies that lived and died during this incredibly volatile era. It's fascinating to contrast the spectacular failures against the resilient companies that managed to adapt. We have the busts, companies like Pets.com, Webvan, and eToys. These were the absolute darlings of the era, only to completely disappear when the capital inevitably froze. But then we have the survivors, companies like Amazon, eBay, and SanDisk. These firms didn't just survive the crash, they eventually grew into the absolute titans of the modern economy. So why exactly did those hype-driven companies fail so spectacularly? Well, they completely locked viable business models and just totally ignored basic revenue sustainability. They engaged in reckless, excessive spending just to capture market share, which basically meant they were subsidizing their customers' purchases. To ground this theory in some harsh reality, Pets.com famously lost $147 million in just 9 months. Think about that. They just couldn't figure out how to cheaply ship heavy bags of dog food. So when the venture capital money finally dried up, the company immediately folded. But it's absolutely vital to remember that even the ultimate victors suffered immense pain during this time. I mean, Amazon saw its share price absolutely tank, dropping from around $100 down to just $10 during the crash. It was brutal. However, what saved Amazon was their ruthless operational efficiency, because they focused on the fundamentals and sheer survival. Rather than just riding the hype train, they were able to weather the storm and emerge so much stronger on the other side. Finally, let's head into Section 5, Lessons for Today, Echoes in the Present. Let's zoom out a bit to connect the past to the present and see how the year 2000 compares to our current AI boom. When comparing these two eras, it's really important to look objectively at the critical differences. In the 2000 dot-com era, we were dealing with slowed 2G networks, and the market was completely flooded with hype-driven IPOs that literally had zero profits. Contrast that with the 2026 AI boom. Today, we have global hyperconnectivity, but much more importantly, the tech and AI leaders of today are generating massive actual profits. The market leaders right now have fundamentally stronger balance sheets than those startups of the late 90s. So, what's the crucial takeaway here? How do we apply these lessons to protect ourselves today? JP Morgan offers some really excellent behavioral risk management strategies for this. First, zoom out and ignore the hype. Just tune out the noise. Second, look closely at the hard facts and the fundamentals. Third, take a broader approach. Diversify instead of betting your entire portfolio on a single, shiny new company. And lastly, you have to understand that valuing future innovation is just incredibly difficult. But hey, always remember, crisis also creates opportunity. Periods of intense uncertainty naturally wipe out the weak, but they also forge the absolute strongest innovators for the decades to come. Resilient firms like NVIDIA, Apple, and Microsoft use the 2000 market flux to refocus their efforts and build highly sustainable empires. The crash essentially cleared the playing field, allowing the companies with real utility and strong leadership to truly thrive. Which brings us to our final thought for today. As we navigate today's incredibly fast-paced, AI-driven market, I really want you to ask yourself, are we actually applying the lessons of behavioral finance? Or is our own deeply wired human psychology setting us up to just repeat history all over again? The technology has evolved, sure, but our brains haven't. Keep your cognitive biases in check, always look at the fundamentals, and never let the herd make your decisions for you. Thanks for joining me for this explainer, and keep learning.